And when I debit cash withdrawal, it acts like an expense account, but it's not. Cash withdrawal is when the company owner takes money out of his own company for himself, okay? This is one way in which they are able to be paid money from their company by simply taking cash out of their own, it's their own company, so they can do with it whatever they want. And if they want to take cash out of it to use for personal use, then that's their prerogative. So I'm going to debit cash withdrawal for $5,100. And sometimes it's not always called cash withdrawal. Sometimes it's called a draw account, but I think the book calls it a cash withdrawal account. And because we actually wrote a check to ourselves, I'm going to credit cash, $5,100. Okay. All right. Next one. On the 30th. The company purchased $600 of additional office supplies on credit. So I'm going to do a debit to office supplies because I got some more of that. So I will increase my office supplies by way of a debit entry. And it says it was purchased on credit. So we are talking about accounts payable. We just paid off our accounts payable earlier. Now we're encumbering some more accounts payable. Last item. The company paid $500 cash for this month's utility bill. According to the book, we're going to use utilities expense. And that's $500. And we paid cash. Alrighty. So we did that. Part 1. Prepare journal entries to record these transactions. Part 2. I now have to open up the following ledger accounts. In other words, what I'm going to do is I'm going to use T accounts because T accounts are easy to follow. So I'm going to have to set up a T account for cash, accounts receivable, office supplies, prepaid insurance, prepaid rent, office equipment, accounts payable, capital, withdrawal, services revenue, utilities expense. So what I will do is I'm going to put this on hold while I build my T accounts.